Welcome to this episode of Next Exit, where we talk to high performance leaders to hear their insights and stories on operating a business to maximize the next exit. Today, we've got six-time CEO, Patrick Dennis. Patrick, welcome to the podcast.
Thanks for having me. I'm looking forward to it.
Before we dig in, we'd all like to hear how you made it to become a private equity backed CEO in the first place.
Yeah. So my story is probably a little different. I grew up on a farm in upstate New York, and so there's not exactly a straight line between that and the private equity world. Although, and maybe we'll talk about this, there are some principles from the farm that I think apply to these jobs that help keep it simple. But I was classically trained in tech, so I went to a technical school, grew up in computer science, did a couple of entrepreneurial things during the dot-com days, and then wound up joining EMC. I was at EMC for the better part of 15 years, with a small stint at Oracle in between there. So grew up in big tech, sort of found my way into doing M&A. And, in those big companies, there are often large teams that work on M&A. And so I sort of started on the fringe as a go-to-market M&A team representative, and then ultimately got into doing some deals myself. And after doing a couple, looked at it and said, maybe I'm on the wrong side of this trade. I think maybe someday I want to be the one that's selling the company, not the one that's buying the company. And I guess that's sort of how it all got started. My first CEO job wound up being a public company, which is pretty rare. We sold that company to OpenText, and shortly after that, that's when I really started to work with private equity. I had met some people while I was at that company, and during a proxy contest, which is no fun. That's a time where you might meet private equity folks. And when I got done with that experience, I said to myself, there's probably something I could learn from these folks. And that was really when I sort of jumped into private equity, and I spent the better part of 9 to 12 months at Vector Capital, sort of before it was really common to have, operating executives, and helped them build out a practice, but also looked at, 400 companies that summer, helped complete a few transactions. So that's the thumbnail sketch of how that all transpired. It took a long time. So, I've probably just said 20 years of my life in, 45 seconds, but yeah, that's how it started.
Awesome, man. Can you take us back to the guidance software days? How did you land that first role and take that to exit to a public company?
I'll give an old executive recruiter a shout out. His name is since retired. His name's Gren Millard. Gren had found me early in my career and said, "Hey, I think someday you're going to wind up in a CEO job." And, I didn't know if that was ever going to be in the cards or not, but I certainly wasn't going to dismiss it. And I stayed in touch with him. And then one day he called me and he said, "Listen, nobody's first CEO role is Coca-Cola, Patrick." And I just had to laugh. And from there, you know, he's like, "I got this little public company in Pasadena, California, that needs a CEO, and it would be a first-time CEO job for you and a public company, which doesn't happen for most people." And so I packed my bags and moved to Pasadena, California. That's how that started. Yeah.
And what revenue is the business at, and how big are they?
Yeah. So, it's funny. There's a lesson in here probably for some of the type of people that think about, that listen to your podcast. That was about a $200 million business, right? So, relative to public companies, pretty small. And, a reminder for everybody, like you sort of typically only go public once. So that's like on your list of things you want to do the right way. You want to get that one done the right way. That company probably went public a little too early. And so, there were some technical matters around the stock. There wasn't enough volume in trading day to day and so on and so forth. And so it sort of got locked. And, to the extent you're interested in that, we can talk about how one solves that problem. But ultimately, it was pretty clear that company needed to go be a part of a larger strategic company. It was around the time where antivirus software was kind of winding down and endpoint detection and response software was coming up. And At that time, there were companies like Carbon Black that were in the market. CrowdStrike had just started and was about as undercapitalized as we were, but earlier in their curve. They've obviously been wildly successful and raised a ton of money, but it was clear if you were in the market at that moment, it was going to be the kind of market where you need a lot of money to compete. And so, for that board of directors, there's kind of this choice, like, do you try to take this little public company and find a way to raise more money, or do you find a strategic alternative? And, um, we wound up on the strategic alternative path. So, also unusual probably to kind of sort of do your first exit and your first CEO job, and sort of in that set of conditions. But I learned a ton about like what did it all look like to take a company public? What are some of the challenges in a public company that, and you've gone through this, like you don't know everything. You move into these jobs and you probably don't even realize how much you don't know. Uh, right. So that one, I learned a lot of structural things about what it takes to run a company. I had great operating skills headed into that job, but like the structural CEO stuff, obviously didn't know as much about. It was a really good opportunity to learn that, and then ultimately learn what it takes to get to an exit.
When you joined, did you know about the need for the exit one way or another, or get the extra capital, or was this further down the track?
No, because I don't think. First of all, the world was a little less sophisticated, right? Like we're going back in like you know whatever 10, 15 years ago now. Um, and so it was less concrete, I guess, sort of how M&A took place. One, two, a lot of the M&A that I had been a part of and had seen was, the stuff you'd remember, right? Like VMware, Data Domain, Pivotal, you know, um, and sort of like what happens in the M&A market for these kind of smaller companies that are maybe lesser known was way less familiar to me. So, I probably didn't know how to ask all the right qualifying questions. Like these days, a lot of people call when they're thinking of roles and they pick my brain on like, hey, what are some questions you would ask the board of directors? And I think I give good advice now, only because like there's a lot of scar tissue. Um, but that one I didn't have any of the scar tissue, right? So I sort of had to find my way through it. We had a good board of directors at that company, um, and so they helped the young CEO find his way,
Yeah,
and very grateful to that team for that. Would not have been done on my own.
yeah. Wow, and how many years were you there?
I think it took us about 3 years and change to figure that all out. Um, there's sort of like year one was at that company, again, a couple $100 million, but there are a bunch of different divisions. And maybe this is a nugget to take away for people that are running companies today. Um, you don't really want to have like a bunch of subscale businesses. So like it was $200 million, but it was really $200 million across four $50 million businesses. And, running that is a lot different than, in your folks' case, right? It's a relatively concentrated set of offers. And so, the logic back then was often scale matters, and I still think that's true. But maintaining some amount of purity in what the core offer is and making sure you're kind of building around that, I think is really important. Otherwise, you sort of won't get credit for the scale. And, ultimately that made that business harder to run, right? Because even when it came to things like trying to figure out the exit, you need to find somebody that wanted 4 out of 4 businesses, right? And that's just frankly more challenging.
So how did that go when you went to market to try and find a suitor?
Um, Hard. So maybe the first piece of advice I could offer people on that is, first of all, I'm in the camp of investment bankers are helpful and useful, particularly if you don't know how to do something. And I oftentimes when I'm talking to folks that are kind of earlier on in the number of exits they've done, I'm like, think of it as like reps at the gym, right? Like those guys do that all day long, right? The bankers live in that motion. So, and how many of you had? And most of the time, some you'll say like 1, 0, right? And you're like, so okay, so put some smarts around you. But the second part of that, which is the more maybe particular concrete part of that advice, is uh, much like all of us, we have different domains of expertise. right? You know, like whenever, and you know this because I repost a bunch of your content. Like I think you guys know more about how you run forecasts than anybody in the world, right? So if I was ever going to ask a question on that stuff, I'd come to you, right? Same thing with bankers. Like a mid-market banker is different than, you know, a high-end tech banker. Somebody that does work with venture-backed companies often different than somebody who does work with public companies. So just be selective. It's probably not as much about the name on the door. Um, I know some lovely people at some really big banks. They're also the kind of people that sell Splunk to Cisco, right? Um, Maybe for what you're doing, you want somebody that's, you know, more in the domain of what your deal would look like. Nobody really told me that early on. So, you know, I probably wasn't as choosy in my first one as I should have been. Ultimately they did a great job. Um, but it really had a lot to do with the relationship more than like me knowing what to go pick, right? If I had to do it again, I'd be a lot more selective in that interviewing process.
So after guidance software, can you tell us about the roles you've had afterwards? Because you've had some great success in getting in and exiting the subsequent companies.
Yeah. So that time I spent at Vector, I sort of one experience was sort of in the middle there, where ultimately the role didn't turn out to be what had been portrayed to me, and you know, I had to make a really difficult call. I left that job immediately upon uh, finding out some news that I thought was sort of not becoming of the company, which is a really hard decision to make. Um, Turned out to probably be the best decision in my career. Um, it was a hard one, but it was like the best one. But it left me a little bit, um, a little bit shy of like, how do you diligence CEO opportunities outside in? Like, how do you do it? And um, I ultimately drew the conclusion you need more time than you typically have. And ideally, you would have some other people with you. And that is sort of what drew me to private equity. I was like, oh, okay, there's a team of people that are working on these assets, assessing these investments. You know, they have different domains of expertise, and you get a more kind of rounded read on the business than maybe you can yourself outside in, even if that company is a public company. Um, and so ultimately that summer we had gone through and we had looked at a bunch of things. Uh, Aspect software came across our desk originally as a credit opportunity. We decided it looked more like a buyout opportunity. And then by the time we sort of got to the end of that process, um, you know, the LPs had said, this is going to be a bigger check for this fund. We'd like you to go run it. And so that began the Aspect software adventure. And that was a very traditional private equity leverage buyout, um, you know, create a value creation playbook, start to execute it on day one, track against the plan, and then, you know, figure out after that, like, are you going to go treat it like a platform and do M&A? Are you going to exit? What are you going to do? Um, so that was very much like your traditional private equity run company, right? Um, and I think probably there, you know, the pattern match to what you folks do for a living. They'll just kind of call out early because we're going to get to it at some point. To do any of these things, like you need to have very reliable financial forecasts. And I'm not just saying it because I'm with you. It's one of the reasons I love you guys. Ultimately, if you're going to get into a private equity backed situation, the consistency really matters. And so, to the extent that you can have really good financial discipline and rigor, that's what gives you the confidence to get into either more private equity deals, a bigger private equity deal, you know, do another acquisition, be confident in your exit value. And I think that's a bit misunderstood by most executives, just like how important consistency and reliability are. And anything you can do to improve those things is ultimately going to improve the quality of the deal, buy side or sell side, you know?
Yeah. I'll come back to that in a minute, but going back to before the Aspect software, you said that was one of the best stepping away from the other roles, one of the best
Yeah.
decisions. What makes you say that?
Um, so it's enough in the rearview mirror now. Like we can go back and, you know, I'll spare the details, but net, I wound up getting an SEC letter on my first day on the job. And I was like, okay, that's a red flag. I'm not doing this. And proceeded to, you know, find my way out of that gig. Um, which is complicated. Like these aren't easy gigs to get into or get out of, and it's an incredibly tough decision. But looking back on it, like that was That was an incredibly hard and right call. I'd moved my family to Colorado. I was wildly excited. Um, you know, all the things that happen all the things that happen to all of us when we take a job. And then, sooner or later, if you're confronted with something like that, I think you just have to like really do some soul searching and say like, you know, is that something I'm willing to deal with? And at least at that stage of my career, I was way too young to want to take one of those things on. Um, and it turned out to be smart.
So going back to aspect software, you sent it to the traditional LBO, you create the plan, and you took the role. What was your 90, 180-day plan, etc. Going in there, and what were you tracking?
Yeah. So sometimes private equity puts labels on things we should all do anyway. So I think if you're running a company as an executive, you should probably have a value creation playbook. It can move in, 90-day increments if you want it to. Um, and you probably need one of those every year. Okay. Now, yes, I think it's true when you first take a job or, um, you just get the transaction done. There's a lot of impact to have in the beginning, right? Where my advice is probably different than most people's. Most executives have a big assess phase. Um, I I'm way less about that phase. Um, my first phase really gets pretty data driven. And it really is just like, okay, do we understand where this company is performing really well? And do we understand where there's opportunities for this company to perform better? Let's answer that question. Okay. Inside this set of things where the company can perform better, are there any obvious no regret moves? If there are, make them immediately. Um, and one of the reasons for that is, um, especially if you're in an LBO, not a lot of people talk about this 'cause it's not a popular term anymore, but ultimately, rule one in private equity is don't run out of cash. So if you can very quickly figure out a set of actions you can take that are going to put yourself in a better cash position, I think you should do them immediately. Putting it off 90 days for more assessment, 180 days for some assessment, whatever, I think is too long. Um, so I tend to think of my playbook in versions like V1, V2, V3. My version one, I sort of assume there's going to be a dot release. Call that your 90 days. Like go with some no regret moves. Turns out a couple of them don't work. Back them out, right? And just try to get some really, really solid footing in that first period where there's been some impact. Um, I also believe in that because I think it preps an organization for change and it gives you a real opportunity to figure out like how a company absorbs change and like Aspect absorb change differently than Venafi, different than Extra Hop, different than Avaya. And that's something that's really hard to figure out outside in. So if ultimately you're going to wind up transforming a business, and at least for me, most of the jobs I take involve that, one of the underrepresented things to sort out early is like how does that organization itself internalize transformation? And it will give you a better compass and a better maybe ruler for assessing what kind of changes are going to be really hard there versus what kind of changes are going to be easy. Um, you and I've worked together on a company that was incredibly data driven. Okay. So two sides of the coin on that. Great that they're data driven. If you wind up in those situations where you have to make a judgment call and the data is not necessarily the best or only way to get to that decision, that can be really hard. So I think figuring out early on what is the kind of like way a company is going to transform is a pretty important thing in the CEO job. That's in that first 90 days. By that second 90 days, I'm trying to activate some transformational element with each one of the people that works for me. All right. And a couple that are cross functional. Typically in that second increment, what you're trying to figure out is, does the company, back to like how transformations work, can the company work cross functionally easily? Venafi could, Extra Hop can't. Uh, you know, um, does the company sort of internalize transformation at the executive level? And then like, do they have leaders that can help? Or is it really going to be driven by, the top executive in that function? Those are pretty important things to figure out. Um, and for me, it's less about the days, Dan. It's more, I want to sort all that out before I have to write my first full fiscal year plan. You get what I mean? So like, I want to know headed into the new financial year that whatever is the plan that I am casting with my team to that board of directors, I understand what it's going to take to execute that plan. Most of the time you inherit your first fiscal year plan just because of the timing of things. It's pretty rare that you get to write it yourself the first time. So yeah, that's sort of how I think of the time frames. And then the stuff that's further out, like how do you write a plan for the next financial year? I think we could spend some time talking about that, but I think there's a broader spectrum of things that you take on when you're looking at your annual operating plan.
Mm, yeah, absolutely. And in your you're talking about the no regret decisions in the first 90 days, the first 180 days. Is that typically more to do with uh, improving the focus, maybe pulling back on a product line, pulling back on certain areas of the business, and doubling down elsewhere?
The vast majority of the time, companies do too much, and you're better off figuring out what things are dilutive. And they can be dilutive in a few different ways. I think most of us are biased for the thing we know best, right? So, like, some people could say, okay, that extra program, I'll pick one that happens frequently. Uh, Go to market external strategic partnerships early in a company's life can be a massive distraction, especially if there's kind of an impedance mismatch. It's a really big company with a startup. It can look really great to the startup. You're gonna have a really hard time getting through to that big company. So like you got to be really picky about those. You know, don't try 100, make one work. Um, that's an example. So yeah, and that first period of time, really figuring out what the core is pretty important. And then like what are the things that are dilutive to the core? Um, and if you find things that are obviously dilutive, yeah, that can fall in the category of a no regret move. There also can be some pretty offensive things that happen. A very, very common um, mistake, problem, opportunity. I'm not the politically correct guy, you know that. So it can all be all three of those things. Most people get their pricing and packaging wrong. Um, you probably can't make packaging changes in the first 90 days. You won't know enough to do that, but you could probably throw a pricing lever. Um, that's something that can be done pretty quickly and is oftentimes a no regret move. Most people are scared of that because most people haven't done it before. They don't have like the core expertise to like figure out how to do it on their own. That's one of, I don't think I've ever had a value creation playbook where packaging and pricing wasn't in the top three levers. So getting in there early and figuring some things out, pretty valuable. And then, just say on products, like you guys know this better than anybody. You have to build at least one exceptional product. If you haven't gotten to one exceptional product yet, you probably don't belong on another product. Um, and product folks love to hear me say that, but sometimes you can be dilutive on product too, just because you're trying to chase things that maybe aren't really you.
Yeah, of course. And going back to the pricing and packaging, when you've gone in and made those changes and you've ranked them in your top three each time, um, would you say that your expertise in that is because of your expertise and experience in the similar industry over time, or is it do you bring in outsiders and pricing and packaging experts to kind of work with you on it?
For me, this one is a both. So I think if I decide to hang it up one day, could I go offer people advice as a consultant on pricing and packaging? Probably. Like I've built a lot of skill in that area. Um, but recency matters a lot, especially especially in your business or in SaaS consumption businesses, things like that. I do think this is one of the times where you pay for an expert, and this is also one of the times not to be cheap. Um, you know, I think McKinsey has probably the best practice in the United States at this. Certainly not the least expensive, but they're very, very good. There are some others that are very good. This is one of those places where I'm willing to pay up for great advice, because again, you want to get it right. And another example of where you should, spend some time interviewing the people that might help you and make sure on this one, you're going to get the people that you talk to during the conversation up front. Um, because these things have a huge impact on your business and they typically have a longer tail. So this is one of those ones you want to make sure you get right. Um, so you pair that up with like fast, no regret buys you enough time to go do like the work to get the right work done. That way your version 2 on that one is like really what you want it to be. Um, it's also great to do a no regret move on pricing early so you can start to see how customers, partners, and the sales force react. Back to change management, that's a change that gets, pushed into your channel or pushed into your sales force, hits your customer. Um, and it's good to get a sense of how that is going to work. That way, when you get to the big change, you're like, okay, I made this change and I sort of know how much consternation was caused over that. Let's learn from that before we go do the big one.
How do you handle changes with a long lead time to essentially knowing the extent to which they've worked, particularly if you're selling enterprise deals for large values and you do a whole PMP update?
Yeah.
It could be quite a few quarters before you see the impact of that from the market.
So I'm a fan of keeping a small group of go-to-market people close to me that are gonna like get me closer to real-time feedback. All right. So it's a sample exercise. You know how those work, and you got to be smart. Right. We don't want just large accounts in the US. We probably want some European representation, some representation from Asia, somebody that works with a channel, somebody that doesn't. Whatever is, a good representative sample of your go to market. And you want to stay close to those teams and just watch how a few deals flow. Um, and there will be some early indicators for you. You're right. In totality, you won't see the outcome for a long time. But if you pick a representative sample and you track it pretty discreetly, um, you know, you'll know early on kind of how it's going. Um, I'll also make a plug for the type of people, again, that probably listen to this podcast. If you were to talk about a couple of things that are really important to me, I love a good RevOps function. Um, and, you guys have always helped me do a good job at that. The other part in that RevOps function that I think never gets quite enough shine is the people that do the win-loss analysis. That's another place where software can make a difference, rigor can make a difference. And it can also be the place where early on you get some anecdotal feedback on whether or not that pricing and packaging change is working. By the way, sometimes it works and it still makes people mad. Like you might find, I think it's been true in your business, like you've now graduated to selling to a CFO, right? Maybe before somebody was selling lower, right? Like oftentimes when you're making pricing and packaging changes, it can work. It's also going to shift the lane of the buyer. And that's something that you figure out when you're closer to the rep, you're closer to a customer. So big fan of get a sample and go to market, not just for the pricing and packaging changes, but any of these like big go to market changes, getting a small sample of go to market that you can trust and is going to give you feedback is super important.
Yeah. You've mentioned your value creation playbook. Do you have one playbook that you've used a similar version of for multiple companies? Obviously, the strategy itself changes per business, but
Well, now I'm old, so it's got a lot of chapters. I don't pull out the same chapters on each one. Pricing and packaging shows up a lot. Um, there's always something that has to do with cost. Even in high growth companies, people forget, and it's an important time to remember it these days. A lot of folks sort of um, wound up taking rounds or wound up in private equity deals when the zero interest rate policy was in place, and so you could spend an awful lot of money on growth and not really worry much about it. These days that's much harder to do, and I think people are wrestling with that through the lens of valuation, but they're also wrestling with that because they're used to spending, you know, um, perhaps more liberally than they can now. Um, so I do think there's always a cost component of a playbook, which is where are we spending the money and are we getting the obvious returns? Um, that includes assessing things like, is it manual? Can it be automated? Do we have the right tech stack? It's really hard to scale efficiently these days without a good tech stack. So that's an important thing to identify early. Um, and then, again, in the playbook these days, understanding your RevOps function moves way up up the ladder in terms of importance. Um, On product, that's less of a playbook. I have an operating model that I use at every company that forces us to interlock certain things. Like the product folks have to interlock with go-to-market. Go-to-market has to interlock with marketing. I use the operating model on day one. And so that tends to bring to the surface operational challenges that may not warrant a transformation project or a PMO or any of that. I try to separate how you just get a company to run and operate efficiently. That happens through the operating model from the set of value creation levers I want to very, very mindfully throw. Um, Typically, I try to do 3, never more than 5. You will eventually cause initiative overlap. Like there will be impacts where one initiative winds up in the way of another one. And so just, this one's probably back to like judgment more than data driven. I have found most companies, by the way, almost regardless of scale, it's true. Company I'm running now is thousands and thousands of people. We have like 5, much smaller companies, 100, $200 million companies have like 3. You're better off with 3 to 5 things that get done than 3 to 5, 30 to 50 things that are sort of, all in progress.
Absolutely. So, what are the biggest pitfalls to avoid that you see in the market in operating and exiting a business?
The one people are going to wrestle with for the next few years, just bluntly spoken, is valuation. There are going to be there's going to be a large number of exits that had a set of criteria that allowed purchase prices that are going to become problematic for people to hit their next round purchase price at a level that they want. I think that's going to be just true for a while. I think we're probably going to see a lot of sideways deals, particularly in large private equity, where, there's maybe less rigor around quality and there was a lot of rigor around getting capital deployed, and people did sort of think about growth at all costs. So there's going to be a bunch of deals where valuation is a problem. And I'm sure somebody that's listening to this is going to go, "Oh, that's obvious. It's always a problem." That's true. I think it's going to be really acute. It's going to cause people to take cram downs and a bunch of other things that are just like super hard to do. So I think valuation is going to be tricky. I think the second thing that's tricky is this notion of efficient growth. Like people are going to have to get better at finding ways to grow on reasonable spend levels with some level of predictability. I don't think give us the money and trust us is going to work. And by the way, unlike before, you sort of need to know what is the optimal amount of growth. So just because you can grow at 80%, but it costs a wicked fortune, might not be the right answer anymore. So second one's going to be tuning there. And then the third one is just, we're in a weird time. So the exit universe is sort of small right now, like the buyer universe. And so I think, for whom I've seen listen to this or who I picture listen to this, like you do have to remember in your exit universe, you need a buyer. And so to some extent, this goes back to the first point. The number of people that can pay $5 billion for a company is smaller than the number of people that can pay 500 million. And I think when you have this weird situation where valuations are high and there's sort of pressure on who can do exits, like finding that match is going to be really tricky. And I'll probably say something controversial. I think it favors the public markets right now, at least on December 15th when we're shooting this. So if we have savvy public market CEOs, they will take advantage of this moment in time to buy at a discount, which might also mean sellers, need to think about their exit universe in a different way. Now, those 3 jump to mind. How are those? Were any of those good?
No, those are all very topical. There's having all the conversations around the rise of continuation funds, private credit, and everything else to assist exactly what you've been talking about. Um, so you've exited both the private equity but also strategic public companies. How how does it differ when you're the CEO of a company and you're running that process?
That's a really it's a really good question. Um, Let me start with some things that might be obvious to me, but I suspect aren't obvious to other people. You have to have a company a public company can buy. And oftentimes the seller doesn't think of that. So, you know, things need to be clean. Your IP needs to be clean. You need to own it. There can't be some dude that was, the third co-founder that nobody talks about that's still in the cap table. So I think the first thing you just have to kind of walk through, and probably the way to do it if you've never done it before, is get somebody with public market M&A experience, probably a lawyer, and ask the question of like, is this company sellable to a public company? All right. And there's probably something on the list that's not ready. All right. Not the end of the world. Plenty of time to clean it up. It's probably just that hasn't been a priority. You know, there's probably some compliance thing that isn't quite sorted out. Maybe there's a hanging tax item from gajillion years ago that nobody's really sorted out. So first question is like, can you get bought, right, by a public company? From there, and by the way, and that bar's high. Okay. Private equity folks can look past some of that stuff. They can assess that risk. They can take that risk on themselves. Public company, you're not going to do any of that. So first question, can you get bought? Figure that out. You know, now the that part's hard. The good news is after that, you're going to get a synergy lever you don't typically get in many other private equity deals, since most public company deals have something to do with, accretive revenue lines, right? Like we're going to book it faster. We're going to go to revenue faster. Maybe it's we're an at scale tech provider who has a really robust sales force. We know we can plug this into 3,000 reps instead of their 30 reps overnight. You know, Dan's given me the character attributes of his deals, and now I know I can scale go to market, super rapidly. So the underwriting process for a public company is, at least in my opinion, a little more straightforward because you're going to get to underwrite it based on some amount of revenue and bookings growth. That also is usually pretty well understood because they're public, they report what they do. You're going to plug it in. Somebody's going to make some set of assumptions. Most of the people that do this for a living are pretty smart. So, between the couple of parties, you're going to push and pull on it until the model works. Again, if you got great forecasting, it makes it even better. But your underwriting process in the public company deal, I think is more slick. When you get to the private side, maybe some of these structural things I was bringing up are less important to them. They probably can see through some of those. But remember, you're going to wind up with a much tighter diligence list. Like it's going to be much more rigorous. It's going to ask every question, because at some point somebody's going to sit in an investment committee and say, why do I want to give Patrick this dollar versus give Dan this dollar to go buy that company? And people are going to want to have taken it to ground. I can tell you, sitting in an M&A committee meeting at a public company, before I bought stuff myself, was part of big decisions. That was all about like the thesis, the underwriting, the growth. Much less of our time in a public company M&A committee meeting was spent on, did you diligence, litigation exposure? Did you diligence the audit? Like, are the financials like completely up to like that stuff? You get a lot more rigor and time. So if you're thinking about those two processes, you're going to do some upfront work that's gating here, but then you can kind of move to how are we going to do value creation, probably on the revenue and the bookings line. Over here, you're going to wind up in a bit of a grind and you got to prepare for it. Again, I'll make my case, like a good banker will help you manage the threshold questions from the low necessity questions and get through that process without being massively disruptive to your business. If you don't manage diligence well, with a private equity buyer, they will distract you. They will cause you to miss a quarter. They will retrade on your missed quarter. All right. Even though they're the distraction that caused it. So you got to manage a private equity process a little more actively, I think.
Going back a bit, we've spoken about your earlier roles, guidance software and aspect. Can you talk more to the roles at Avalara and subsequently?
Yeah. So what happened with Aspect Software was we had effectively turned Aspect around, and this is a case for how you contemplate another leg of value creation in private equity. Um, Compliant outbound dialing turns out to be a relatively small domain, relatively small number of players. Aspect had a pretty large software presence there, and so what created Alvaria was the merger of Aspect Software and Noble Systems, and we concurrently merged it, sold it to Abry Partners, and took it back out as Alvaria. Um, so that one was, yeah. So that was a sale process, a purchase process, a finance raise, and then taking a brand new company out to the market.
Four exits in one.
Yeah, that one was yeah. I used to refer to that one as in bowling. There's like the 7-pin and the 10-pin. So the 7-10 split is when the one pin hits the other one. Yeah, and the thinking there was the combined company was going to have a really strong position in compliant outbound dialing. That was coming on the heels of COVID, and so delinquencies were up. So there's a lot of structural reasons to do that deal at that time, but it also got liquidity for one of the private equity partners and allowed us to also recapitalize the company. We raised. It's actually kind of a funny story. A little more than $1.3 billion over the telephone to make that deal work, because that was back at COVID, like nobody could see each other. So,
Yeah.
Yeah, so that one will be one that we someday when I retire, that one will be a chapter in the book. It was a fun deal to work on.
That reminds me of I don't know if you've seen the screenshot of Larry Ellison and Elon Musk texting. It was like, should be 1 billion or 2 by text message.
I wish I had that problem.
Yeah. So looking back, how much do you think is the aggregate value of all the exits you've run?
I sort of want to retire at like 10. And I think I got probably, well, Venafi was more than $1 billion. Aspect and Noble were $1 billion. Probably halfway there. Someday there was one that was like part cash, part stock, and then the stock doubled in the period that we had the stock. So I'm not quite sure how to count that.
Yeah.
If you ever have me back, I'll answer the question. I'll go do the math.
Yeah, absolutely. I will.
There's at least 2 times the work left to go, man. So be around for a while.
You need a dashboard, like a lifetime dashboard.
Yeah,
That makes
right,
dashboard. Yeah. So I guess looking forward, how do you see the market? How do you see the market playing out, both in terms of the market you're in right now, but also for other CEOs and the C-suite out there? You said it's going to be tough, and the public markets might be licking their lips a bit.
Yeah, I think we'll start with the least controversial, and then we'll go to like pretty controversial. I think right now public markets are in a good spot. So whether that's, I also think I know nobody's going to believe me. I think it's also a good time to take a company public if your company's in good standing. Because I think this is going to be a time where people are looking for higher quality assets, and there just aren't going to be enough of them, because you're going to see them wash out in private. You're going to see them wash out in public. So I would not be afraid of taking a company public as an exit mechanism. Notwithstanding my first piece of advice, which is you only get to do it once typically. So, you got to make sure it's lined up. But like the other thing is staying private for forever isn't the answer. So, yeah. So if I was a CEO sitting there or a founder and somebody had said to me, you should go public a bunch, and I had said, no, I might take that call for the first time and really hear somebody out. I think this is going to be a time where small funds are going to outperform big funds to a large extent. I think you're probably going to see, they're going to hate this, but I think you're going to see a bunch of turnover of MDs in private equity firms that actually never lived through real investing. They lived through COVID. They lived through ZERP. They haven't had to see um, buying into and creating durable businesses. I could think of two friends who shall remain nameless, given this, what we're doing here today, who have had a conversation with me recently. They're probably 10 years younger than I am. Like, I think this is the first time I've ever had to do real investing. And I think that's probably true. So I think we'll see some shakeup there. Um, my wildly controversial take is I think you could build $1 billion company now on 3 to 5 people. Um, and so this is sort of like my version of the AI hot take, and I'm sure you've gotten all the usual ones, so I'll try to give you something different. Um, the cost has never been lower to start a company. The barrier to entry versus a competitor has never been lower. There's never been a better time for speed. Uh, there is a giant asymmetry right now between the ability for smart people to actually do smart people things and get a result versus like have the big monolith hold you down. So my super hot take would be if you're sitting on top of the best idea of your life, this is the best moment in the history of tech, at least, to go try it. Um, and so if you're really in the value creation business and you have put off starting a company for any one of a number of reasons, I think these days you're only left with your own intestinal fortitude as the barrier. The rest of the conditions are really, really good. Flip side of that is, um, if you're not thinking about really meaningful ways for your business to look different during this time, the person I just talked about is probably taking you out. So, um, I am not in, I'm not a AI doomsday person. I'm also not a doom scroller. Um, there's this economist named Jevons that had gone back and really predicted that every time we get major price decreases structurally, we always make up for it with consumption. It's turned out to be true more than it's turned out to be false. So I think there's going to turn out to be more consumption during these times than there is going to be this AI doomsday thing. Um, but I think the way we might see it might look different. We might see smaller companies that can scale really quickly that are more temporal till the next good idea comes. So I think building durable businesses is a little bit harder right now. Um, and if you are in the business of building a durable business, you better be thinking pretty hard about what that one looks like. Probably a good one for that. I don't know. I don't know if that's what you expected me to say, but
No, absolutely. I see you post quite a bit about AI and quantum and things like that. I knew you've got some great insights there. Um, I think it was Michael Dell who always said you have to imagine what your most aggressive competitor would look like,
yeah.
then basically beat them before they exist. So I guess for you as the CEO right now, are you taking that mindset internally and saying, what if 5 super smart people build a competitive product? How can we do a similar thing internally?
Yeah. We did a couple things just to be transparent. This company's been around for a really long time. We actually did a company-wide program on AI where and I was pretty upfront with everybody about this. So it's like, I remember, and you can't laugh at this because like, I'm older, but I don't think I'm this old. I watch people move off of papers onto Excel, right? And like a whole generation of people just retired because they didn't want to do it, right? And, and so I think we're in another one of those moments where like this is pretty foundational. I know you work with people that are kind of like born in this era. They just work different than some people that were not. So we went through a big reskilling and upskilling program at the company level because I think that was the right thing to do for the workforce, whether they wanted to or not. They are in a paper to Excel moment, and if they want to remain relevant in any workforce, they had to build some of these skills. So we did that, right? And if you run a large workforce, you owe it to them to do that, right? Now on the other side, um, we have a combination of Cursor and Claude Code being used by the dev teams. We're not trying to do anything. We never put out a goal that's lower. So a lot of people keep talking about cost, and I think they're nuts. I'm getting 30 to 40% more output with the same group of people. So I think the way to think about it is like, what if you could have your roadmap twice as fast? Like, how much more could you compete? How much better would you compete? Right. And so I think there's just a little bit of a mindset shift. Product, that one's easy. Go to market. The teams have been doing just a much better job. Like the superstar rep is going to 10x again because you're going to get more customer insight. They're going to grab, output from, software like yours, mash it up with other software, get better customer analysis. So I think right now you're seeing those things. They should happen two ways. Some programs coming from, executive top down, some amount of it bottom up, foster organic growth. We wound up with like our equivalent of a Slack channel that is all about like just people around the company that are doing things with AI. And I'm pretty amazed at, the things people have come up with on their own because it's helped make their own job better. So my core piece of advice would be try to get to a place where you make it organic. Don't let it be optional. Um, and then you just got to listen because the 5-person company that's coming out of nowhere, those people are leaving work every day. They're having a beer together downstairs and they're talking about the next thing that they could do to push a frontier. They don't have the bureaucracy that goes with layers and countries and distance. So they're going to go fast. And probably this second core piece of advice would be like, you got to figure out how to be faster. If you're big, and that's tricky, right? That those two things typically don't match well. Got to figure it out.
Yeah, absolutely. Sounds like we're going back to your no regret moves with that.
Yeah.
Yeah.
Well, I'll tell you something, man. The thing about no regret moves that, so I had a person that worked for me at Venafi reach out just a few weeks ago, and he said, so Venafi went to CyberArk now to Palo, and he's exceptional guy. Says, hey, I know we didn't get to work together for very long, but I really have taken away this notion of no regret moves. And I think it was interesting what he said about it. He's like, when I heard you say that, then I could start to do it. And now that I've started to do it, my people have started to do it. And so it's interesting, but it can catch on and you might get the impact will be beyond the ones you've identified. More people will start to think to themselves, oh, we certainly have the risk tolerance to do something where there's no regret. And if everybody did that, that's one way to cheat. That's a cheat code to go faster.
Yeah, absolutely. This is awesome. And you said at the beginning something that I wanted to bring back at the end once we'd heard your insights or near the end. You said you were brought up in a farm in upstate New York, and you've got some insights or ways of working that have applied to your career.
Yeah.
What could they be?
Well, I grouped them all together under the precursor of when you're going to get that advice is I'm like, we're going to use farm logic on this one.
Right.
And, farm logic tends to be really straightforward. If you think about the process of farming, almost regardless of what you're farming, you got to take something that's relatively nascent, call it a seed, you got to plant it, you got to give it the right conditions, it's got to grow, you got to get it to a good place through nurturing it. Once it's nurtured and it's grown, then you actually have a relatively small period of time to go pick it, put it in a can, and put it on like whatever you're going to go do. And so, one of the things about the act of farming is there's a process that has to be followed. There's relatively tight tolerances on when you have to do things, and the consequences are pretty high. And, for whatever reason, we can always convince ourselves in these companies to leave the apple on the tree 1 week longer. This is just one example. That apple will go bad in the real world. And I think oftentimes that's what causes us to miss opportunities. There's a certain rigor to working on a farm. There's a certain rigor to working in these companies. Now, you don't necessarily go home as tired, perhaps. These jobs are certainly more safe than we used to have this giant saw to pull. Like you'd take big trees and you put it on and you come out with planks of wood. Okay. And the blade that does that is as big as you are. So like this is a more safe set of occupations. But the rigor that goes on a farm also can apply to a company, and then the other thing is farmers tend to be simple because they don't have a lot of room for all the complications. And we have created enough room where we can complicate things. So yeah, you can go back and every once in a while just kind of use some farm logic on something and might turn out that it's more the right answer than the thing that looks like, if you're in a meeting and the person that's making the recommendation on the project has something that looks like particle physics on their whiteboard, that's like a good clue to go like, what would the farm logic approach to this be if we didn't need, and it also, nobody has ever been worried about a farm. So sometimes it also just gets everybody to kind of take the temperature amplitude of something down a bit and be like, yeah, like if we're just going to kind of go back to, we'll use Elon's words. Like if you're going to use first principles, what would we do?
Yeah.
Right.
So just to finish off, Patrick, what does the future hold for you? It sounds like you've got at least another 5 billion of exits to hunt down.
Yeah. So, Avaya, we have a big moment right now because voice has become really, really important. And, in my day job, what I often say is, we all shipped with one user interface and it was voice. Maybe we didn't agree on the language, but most of us want to interact with other people using our voices like we are now. That has made the intellectual property at this company really valuable. So it's an exciting time here. I spend some time with a company called Ripcord that built robots to ingest paper, scan it, digitize it, and then move it to the cloud or do something with it. So it's cool time to be in a business where there's digitization and automation. My friend David's business at Higher Brain is really using AI to help people make better talent decisions. He's going through a lot of growth right now. And that's sort of let me dabble in investing a bit. And so, yeah, we got a good run here at Avaya. I got a couple of companies I've made some investments in that I think are going to have a good run. And somewhere along the way, I'm going to take my own advice and try to take advantage of the market opportunity. But we'll see when that door opens.
Absolutely. Fantastic. Well, Patrick, thank you again for joining us. You've shared some hugely valuable stories and insights for our audience.